Welcome to the Small Business Tax Savings Podcast, your weekly dose of accounting and tax tips specific to small business owners. You will be on your way to growing your business and paying the least amount in taxes as legally possible. Here's your host, Mike Jesowshek, CPA.
Hello and welcome back to another episode. Today's topic is, do I have to pay taxes if I sell my home? Now, we just finished up a real estate series that we were doing, and I just kind of want to throw this one near the end of it because I feel like although it's not specific to rental properties, it's not specific to business owners, it's a question that comes up, especially with the kind of crazy market we've had a lot here, and some people maybe have sold already this year. And so let's jump into this. So if you're looking to sell your home but may make a big profit on it, or if you're wondering you need to pay tax on that gain, this is a question that we've seen pop up in both our free Facebook group, our tax minimization program. So we want to tackle it. Now, fortunately, the IRS has something called the home sale gain exclusion, which allows you to potentially pay zero taxes on the gain from a personal residence. However, there are some things that you need to know to qualify, and that's what we're going to be discussing here. So what is this home sale gain exclusion? If you qualify, you can exclude gains up to a certain amount on the sale of your personal residence. And the gains that you can exclude, if you're single, you can exclude up to $250,000 of gains. And if you're married, you can exclude up to $500,000 of gains. Now, in order to qualify, you need to pass two separate tests, an ownership test and a use test. And the ownership test is that you must have owned the home for at least 2 of the last 5 years. And the use test is that you must have used the home as your principal residence for at least 2 of the last 5 years. Now, if you have a gain larger than the exclusion, then you would need to report that as a taxable gain. This will be done on your Schedule D on your Form 1040. Now, if you do not meet the test above, but are forced to sell due to a change in the place of employment, health reasons, or other unforeseen circumstances, you may still be eligible for a prorated gain exclusion, but that you want to dive deeper into. So the question again, so let's go back to that again. What can be excluded if you're single, up to $250,000 of gains, and if you're married, up to $500,000 of gains? Again, this is gains. So if you bought a house for $300 and sold it for $500, that's a $200,000 gain that you can have there. If you're single, you can exclude up to $250, married up to $500, as long as you pass two separate tests. The ownership, which is you must have owned the home for at least 2 of the last 5 years, and the use test, which means you have used the home as your principal residence for at least 2 of the last 5 years. So the question that often comes up is, how does the home sale gain exclusion work if it had business use in it? So if I had a home office in there, if I used that home for business, if you used a portion of your home for your business portion of the home would still qualify for the exclusion. Now, with that being said, if your office was not located inside your actual home, but rather an unattached building on the property, like a garage or a shed or something like that, you're going to need to allocate the gain between your living portion versus your business or your office portion. To help avoid this, if you know you're planning to sell within the next 2 years, you can simply move your office into the home at least 2 years prior to the sale. So again, if your home office is, your business portion of it is inside your home, it still qualifies for the exclusion. Now, one important thing to note is that if at any point you claimed depreciation on your business return for your home office, regardless of whether it was attached or unattached to your home, you would need to report unrecaptured Section 1250 gain on that depreciation portion. So if you were taking depreciation on the business side at any point, you're going to have unrecaptured Section 1250 gain that needs to be reported. But as long as the home sale exclusion, at least that part, if it's your business is inside your home, you're fine. If it's a separate, unattached property, like a garage or unattached garage shed, something like that, you're going to need to do some allocation. So let's go through some examples, kind of bring this all home, as we'll say. So let's say you purchased a house for $200,000 and live in it for years 3 and 4 and sell it in year 5 for $400. You would qualify for the home sale exclusion because you have met both the ownership and use test. Let's say you purchased a house for $200,000 and live in it for a year and a half and sell it for $300,000. You would not qualify for the home sale exclusion because you do not meet 2 out of the 5-year tests. Now, you may qualify if you have a special circumstance, like a job change, health, things like that. But in this case, you would have a reportable gain of $100,000. $300,000 you sold it for, purchased it for $200,000, only lived in it for a year and a half. You did not meet that 2 out of 5 year test. Now, let's say you purchased a house for $200,000 and lived in it year 1 through 4 and sold it in year 4 for $400,000. But you had a home office inside the house. You did not take any depreciation on your business for the home office. You would qualify for the home sale exclusion on the full amount since you met the ownership and use tests. The office was inside the home, so you did not take depreciation on the business side, so there's nothing to take there. But let's look at the same example as above. You purchased a house for $200,000 and lived in it for years 1 through 4 and sold it in year 4 for $400,000. You had a home office inside the home, and you now took depreciation of $5,000 per year for the 4 years that you lived there. You would still qualify for the home sale exclusion on the full amount since you met the ownership and use tests and because the office was inside the home. However, you would need to report $20,000 in unrecaptured Section 1250 gain because you were taking depreciation for that on your business side. So ultimately, the home sale exclusion is a great gift from the IRS to avoid taxes on the sale of your principal residence. But with that being said, you do want to make sure that you have everything set up correctly to ensure that you qualify. And one last thing is if you plan to convert your home to a rental property, you may want to look into selling your home to your S corporation and then using it as a rental. This can get complex and doesn't make sense in every situation, but we do talk about it within our tax minimization program. So if you're looking for more information about that, check that out. Bottom line, if you're selling your home, make sure you're talking with your advisor, asking in our tax minimization program to ensure that you can take advantage of this. Do not be like a good client of ours that came into tax season, was so excited, they told us about a home that they sold without coming to us first, after only owning it for 19 months. They had a big gain on it, did a bunch of work on it, owned it for 19 months and was so excited to talk to me about it, and then they got hit with the tax bill. So don't be like that person. Just make sure you're looking into these things. Of course, we don't want to make every decision about taxes, but there is some times where, hey, waiting a few months would have saved them so much money in taxes that might not have been necessary. So definitely look into that. Again, just as a summary, the home sale gain exclusion, basically, if you qualify, allows you to exclude a certain amount of gains where you don't have to pay taxes on. If you're single, you can exclude up to $250,000 in gains. And if you're married, you can exclude up to $500,000 in gains. But in order to qualify, you need to pass 2 separate tests, the ownership test and the use test. And basically what that means, the ownership test just says you must have owned the home for at least 2 of the last 5 years. And the use test says you must have used the home as your principal residence for at least 2 of the last 5 years. You meet those 2 tests, you're able to exclude up to $250,000 or $500,000 in gains on a home sale. So hopefully that was helpful. Again, we want to put this one close to our real estate just because it does have to do with real estate, although not necessarily a rental property. It does have some real estate activity related to it. If you want to check out our whole series that we did on real estate, go to our Ultimate Guide to Real Estate Taxes. You can go to taxsavingspodcast.com/real estate. And just some closing notes. If you're not a member of our free Facebook group, join now. Go to Facebook, type in Small Business Tax Secrets, answer a few questions, and join the conversation. Or if you're also not a member of our tax minimization program, that is basically our program where we take business owners from paying too much in taxes to paying the least amount in taxes as legally possible. We have a bunch of stuff jam-packed in there, including access to our team for those general tax questions you have, library of tax strategies, downloads, so much more. It's an incredible program that we are seeing life-changing effects of people going on this journey from paying too much in tax to the least amount of tax as legally possible. So if you're interested in that, check that out. Now is the time to join. You can go to taxsavingspodcast.com/tax. I want to thank you for listening to another episode. I want to thank you for going along this journey of real estate with us. And next week, we're going to be back with a whole new type of topic, and I hope to see you there. Thanks again for listening to another episode. I will see you all next week.
This has been another episode of the Small Business Tax Savings Podcast. If you enjoy our weekly episodes, please leave a review and share with other business owners. You can find previous episodes and more information at www.taxsavingspodcast.com. Thanks for listening and have a great day.